Hello there. Thank you for joining us today. My name is Marche. I'm the webinar director here at Advice Chaser. Before we introduce our guests and get started, we do need to do a little bit of legal housekeeping. Advice Chaser, the host of this webinar, is not a registered investment advisor. We cannot and do not give financial advice. Today's presentation is for educational purposes only and cannot be considered advice for any person's individual situation. Advice Chaser regularly hosts informative webinars such as this one, featuring a variety of knowledgeable professionals, many of whom are licensed advisors. Any opinions, ideas, jokes, or principles expressed by presenters are their own, and however true, funny, or interesting, are not endorsed by Advice Chaser. Please do not act on the information you hear today without consulting a qualified financial professional. Well, we are thrilled to bring you this educational presentation. Attendees are muted, but we do encourage you to ask questions using the chat box, and the presenters will answer those queries during or after the webinar presentation today. And we do have a question and answer period at the end of today's webinar. So a couple other little notes. If you ask a question in the chat box and we're not able to get to it, go ahead and leave your phone number or email address as well. If we can't get to your question, we'll make sure someone reaches out to you after today's event. We want this experience to be as educational as possible, so please don't hesitate to ask for clarification or expansion of the material. Well, I'd love to introduce you to our presenters today. Catherine L. Sajan is the President and Executive Director of Christian Foundation of America. Her career in philanthropy spans 37 years. She has served on the board of Christian Foundation of America since 2002. A career executive in philanthropy, she served as the Chief Financial Officer of the Fuller Foundation in Pasadena, California, for over 12 years. Previously, Ms. Sajan was the Chief Financial Officer of 2 multi-billion foundations, as well as the California Endowment, and as VP for Finance for the Kellogg Foundation. She is a member of the American Institute of CPAs and the California Society of CPAs. Catherine is passionate about bringing Christian-based stewardship, philanthropy, and giving services to families and ministries. And our second panelist today is Ransom H. Adams, a partner and wealth manager at U.S. Capital Wealth Advisors. And Ransom earned a bachelor's degree in financial planning from Texas Tech University. He holds the designation of Certified Financial Planning Professional and has over 15 years of experience in the financial planning world. Outside of work, Ransom is a husband, father, and an Eagle Scout. Ransom is based in Austin, Texas, but serves clients throughout the entire United States. And I'm so thrilled to have both of you here. And Ransom, I'm going to turn over the time to you.
Thank you. Appreciate the introduction. So today we're going to cover charitable gifts and giving retirement assets and just how to increase your legacy and what's an appropriate way to do that. There are many reasons for really wanting to be philanthropic and trying to find ways to accomplish your lifetime philanthropic goals. We can always give a course now while we're alive. We can also give at a bequest upon our passing. Reasons to give, right, are pretty obvious, right? In the clients I work with, it's a part of their values and a part of their kind of their moral fiber, if you will, to give back and help those that are less fortunate and participate with organizations that do good things, not only here stateside but globally, and they want to support those organizations and the people they care about. Sometimes families will be affected by a certain cancer or disease and want to give in those ways. But it's a great way to make a difference. And to me, the big impact on doing this while you're alive is to see the benefit that it brings, the joy that it brings, and the good that it can accomplish. When you pass away, of course, your legacy will be able to enjoy those things and see that benefit, but you will not be able to. There's also some tax benefits to donating and being philanthropic while you're alive as well, which we'll get into more details on that later. I think it's important, right, to if giving back and volunteering for charity is important to you, you can start to really create that legacy for yourself and leave that template behind for others, your grandchildren, your children. And again, there's many tax advantages to gifting during your lifetime as well. If you make a regular gift out of cash or stocks in an individual account or a joint account, right? You can deduct as much as 60% of your adjusted gross income. There are some other limits to that as well, depending on the type of thing you want to donate, whether if it's cash, stock, or real estate, anything of that nature. It's also very advantageous to donate from our IRAs. We are all required to take a minimum distribution when you turn 72, and this was due to the recent changes, which was the biggest change in retirement tax law ever, which went into effect in 2021. So now the minimum age is 72. However, to do a qualified charitable donation, the minimum age is 70 and a half. So it's the old rule. So you can start the charitable qualified donations earlier than 72, and it's a great way to reduce part of your IRA so that future contributions and then future money from it aren't taxed as high, and kind of reduce some of that. But you can do up to $100,000 on a qualified charitable deduction every year, and you can donate your required minimum distributions at the same time. It does matter what you donate. Charities don't really want the old used Pontiac in your backyard, and there's not a whole lot of tax benefits to donating something like that. So I'll encourage you, right, to consult with whatever charity you want to support, consult with your financial advisor, also your CPA, and I like to loop in an estate planning professional as well, just to make sure everyone's on the same page. And really, if it is your goal and it's your inclination to be philanthropic in life and at death, you need to really have a plan around how to accomplish it and how to get there. And of course, you want the charity to benefit from your gifting and your generosity, but at the same time too, you can also benefit. And so it's really making sure we check all the boxes and what's being done is appropriate. It's the right thing for the short term. It's the right thing for the long term. And then working with the charity and with the CPA will make sure that we're checking all those boxes and getting everything that you deserve, while at the same time helping the charity and getting everything that they deserve as well. Really, I'm going to turn it over now to Kathy, and she's going to get into a little more detail, and then we'll have plenty of time at the end for question and answer. And there's a lot of information and a lot to really digest when it comes to charitable gifting. And so if you have any questions, please type them in. We're happy to answer them. And Kathy, go right ahead.
Thank you. Well, I want to say right up front, just listening to Ransom share with you the reasons to give, how beneficial it is if you are working with somebody who can help you with your overall financial planning. I work for a charitable foundation. We'll get into some of the details of what we do here and how, you can make gifts from retirement assets work, but I'll just share with you all right up front that the hesitation that we sometimes see with our donors is worrying a little bit, just frankly worrying, can I afford to give? What happens if I outlive my money? I'd like to do more, but I get kind of nervous about that. I don't know how it fits. So there's such value in having a team come alongside you that can help you make those decisions. We often encourage our donors to think about, making like a lifestyle decision, and then working on what you can do with surplus resources that you have to benefit charity. We've got one of our board members who loves the phrase, do your living while you're giving. So you're knowing where it's going. And the heart of that is really, it's such a blessing to be a generous giver, to be active with the charities. Charities love to have donors who are in partnership, who are very actively engaged. And so it's such a blessing. I'm a grandmother. I know that teaching my grandkids and obviously, encouraging our kids to do this stuff is top of mind. And when we share the importance of legacy, people traditionally think, well, that's what my kids and grandkids are going to receive in terms of financial assets after I pass away. But consider the community you're leaving behind also. And so we can help to strengthen that community and at the same time pass along those values of taking care of the things that matter most in our community. And so much of that comes from what's called the fourth estate, which is charity. So today we're talking about, giving from retirement accounts, and Ransom touched on some of these things. And what we're, specifically talking about is giving to charity from your IRA account, a 401k account, other kinds of tax deferred savings accounts that can save you taxes along the way. And we all know that the money that goes in to those accounts is tax deferred up front, which is phenomenal. And getting good sound advice on how to invest that until it's time to tap those is beneficial, because those can grow much stronger with all of that. And so one of the things that I love to point out is that the inheritance that our family receives from all of our estate, the value of our home, other investment accounts, retirement accounts, is not treated equally under IRS rules. And so Ransom knows well, if our kids or grandkids inherit retirement assets, they're going to pay ordinary income tax rates. So one of the main recommendations we always share is, if you're including charity in your estate plan for gifts after you pass away or during life, consider giving them from your retirement assets, because charities don't pay taxes. And so that keeps that out of taxable income, and you can just kind of flip and switch the assets that family gets that get a step up in value when you pass away versus retirement. The other thing is, we all know, those of us who have IRAs and 401ks, this is probably our largest liquid nest egg for most families. And so sometimes we're worried about what's our annual income going to be. We're trying to budget for fixed income in those later years. But a gift from the asset base may not affect your income that much. And that's where this QCD gift that Ransom has shared with you is such a powerful way to think about making a gift to the charities that you care so much about. And so really take advantage. We sort of refer to it as QCD. It stands for Qualified Charitable Distribution. Just think of it as an IRA rollover to charity. There's another idea I'm going to touch on in a moment, and that's how you can also use what's called a stretch IRA strategy, so that the IRA assets that your family does inherit, it doesn't have to be paid out over 10 years. It can be paid out over a longer period, and I'll touch on that later. In this world of giving QCD assets, one of the things that the IRS put in place was a restriction on what you can give to. A qualified charitable distribution can go to any public charity. It's kind of a wonky term, but those are your churches, local charities, things like the Red Cross, the Cancer Society. All of those are considered public charities. And if you have a question about whether something is or is not a public charity, just ask them. The big red flag would be a family foundation. There are many foundations out there that are private, they're not public. And so that's what that really means. And so let's go to the next slide. Oh, I'm sorry. Let's stay here just a second. I'm sorry. I wanted to mention, because I'll talk about a giving technique that we do here. While you cannot give to a donor advised fund, it is possible to make a gift to a public charity that goes into a restricted fund that does not have donor advised fund characteristics. And examples are field of interest funds, scholarship funds, things like that, that can have a long-term life to them. And so that's something that uniquely some charities, particularly community foundations like ours, may make that available. At our place, we call it the Harvest Fund. I may refer to it that way in my comments, but just know that these gifts have to go to a public charity. They cannot go into a donor advised fund, but it is possible to do long-term giving, even though it's going into a public charity. So now we can go to the next slide. So just some planning points. Any giving from retirement accounts, if you're in an active 401k, you're not apt to be able to make withdrawals except for emergency purposes. And so this is usually once money is transferred into an IRA account that you control directly. You can make withdrawals out of your IRA account anytime. Just remember that until you hit that age 59 and a half, there's an extra penalty tax. And so we generally recommend this for folks that are over age 59 and a half as a place to make asset distributions. That magic age of age 70 and a half for the QCD is even better. So the general rule is that withdrawals are taxable income. And if you're an itemizer, you deduct gifts to charity that come after you've made that withdrawal. And so consider the impact on any withdrawal that you make from retirement accounts on adjusted gross income. And again, that's where a financial planner, tax advisor can kind of help you work through that math and figure out the best way to do those things. Like I said, inheritance to families taxed at ordinary income tax rates when it comes from retirement assets. So thinking about giving to charity from retirement assets is always a good strategy. And then I'll touch on the stretch IRA payments in a later slide. As Ransom said, the QCD is for folks, once you hit that magic age of 70 and a half, up to $100,000 to charity annually. And I'll tell you, it's fantastic. We have many, many donors who now they understand this rule, and they might celebrate their 70th birthday, but they really celebrate their 70 and a half birthday. So it's kind of a cool thing to do, to think about when you're 70 and a half, light up another birthday cake and know that's when you can start doing a QCD. Okay, we can do the next slide. Ransom mentioned real quickly that, you know, there's all kinds of charitable giving. I'm not going to spend a lot of time on this slide. Cash is always best because the tax benefits are better. And charities love getting that. You can make gifts out of other kinds of assets. Today, we are focused on IRA giving, but consider that it's just one tool in the toolbox. On the right-hand side, there's different ways you can make gifts from your retirement accounts. And so, you know, if you take a direct withdrawal, that's going to be money that comes to you that's taxable income. It's yours now. You just turn around and you can make a cash gift to a charity by check or a bank transfer. A lot of charities accept them that way. So that's always a way to give. Securities are not typically given out of retirement assets because there's no real advantage. Occasionally we see that happen if the security itself can't be, you know, liquidated right away, and there's a reason to want to get that distributed if the charity will accept that. So it is an option. It's just not usually a tax advantage for you to do that. Again, this QCD, we just want everybody to understand how powerful this is. The idea that you can give up to $100,000 a year to charities, churches that are these public charities once you hit age 70 and a half. And the key is this has to be a direct distribution from your IRA custodian or trustee. There have been questions about, well, if I have a direct checking account in my IRA and I write the check directly to charity from my IRA on my checkbook, does that count? And I will tell you that the IRS is not given very clear indication on that. The fail-safe way to do this is to contact your custodian. If you're using an advisor, contact them because they know how to do this request on your behalf. But the fail-safe way to do it is contact them and ask them to process a QCD distribution directly to charity. When you do that, you're giving them the charity name, address. I always recommend you give them their tax ID number, which you can often look up, where the charity will be happy to give to you, because your custodian should be verifying that that's a direct gift to a charity. Some are, some aren't. When that happens, then the charity sees that check coming directly from your custodian rather than coming from you personally. And that's how you get this QCD treatment, which allows you to avoid adding it to adjusted gross income. Why does that matter? Again, there are things that an advisor can help show you the benefit of keeping your taxable income lower, having Social Security not taxed, not getting kicked into higher Medicare premiums, all those kinds. There's a lot of wonderful reason. If you're doing this and if you're charitable and you're making distributions and you're age 70 or older, you definitely want to take advantage of this. Okay. Another way you can give from IRA assets is the way that we, name our family members. And that's simply going back to that pay on death form, that beneficiary form. You can add your favorite charity or church or whomever as a beneficiary on your IRA assets. And that can happen. It's always best if you've got a living trust, which we hope you all do, to make sure all those instructions are in sync. And that's where having an advisory team helps you make sure that what you want to do is in sync with what your documents say. We can do the next slide.
Before we go to the next slide, we did have a question that I thought would be salient to ask here, and Ransom, you can chime in. One of our viewers has asked, does giving from the IRA via QCD, does that affect the annual RMD, the required minimum distribution? Can you speak to that really quickly?
Yeah, sure. So yeah, essentially, you would donate your required minimum distribution up to $100,000. Essentially, when you turn 72, the math is a little different, but it's essentially about 3.5% of your December 31st prior year balance in your IRA is what your required minimum distribution is. So if that turns out to be $68,000, of course you can give the entire $68,000 RMD to the charity, and then that would not be taxable income to you. If your RMD was $120,000, you would only be able to give 100, and then the remaining 20,000 would be taxable to you as ordinary income. Good point, and something that Kathy brought up too, with the donor advised fund, right? That's a good way to give to charities, and it's an okay way to do it. But as soon as you transfer money into a donor advised fund, that's no longer your money. You don't have any control over it at all, other than to say who it goes to. And so you lose that flexibility, and it's really it's a fine way to give if that's what you want to do, but understand the restraints and the limitations of that, and then also understand the restraints and the limitations of a QCD, the qualified charitable distributions. Also too, to kind of clarify rules and not be so overwhelming with all of this, the key rule for an IRA not to be penalized for taking a distribution is 59.5. And Kathy mentioned you can do a charitable donation at 59.5. There's just not a whole lot of benefit to that yet because it's still taxable, and there's still some consequences for that. However, some of the tax benefit may help pay for the tax income on that distribution, but it's not a qualified charitable distribution because you have to reach age 70.5 first. Then you qualify for the qualified charitable distribution. But again, you don't have to take any money out of your IRA until you're 72. And those rules just changed a couple years ago. And so a lot of people still have that 70.5, the time frame, molded into their mind because that's what it's been for the last 40 plus years. So just know there's a lot of different rules, lots of moving parts and pieces to this. And again, we'll try to keep it as straight as we can, but I can't emphasize enough, right? Bring in a financial planner, bring in your CPA, make sure everyone's on the same page so that we don't accidentally shoot ourselves in the foot from a tax perspective. Awesome. Go right ahead, Kathy.
No, I think you covered it well. Okay. All right. So I wanted to spend a little bit more time talking about this idea of making a QCD gift into a restricted fund type, because we often see donors who are very interested in being active in their charitable giving. They've done their financial planning work. They're comfortable with their finances. They're comfortable with, what they'd like to do. And now they're really thinking about how can I leverage the best tax savings possible. We sometimes see folks in those kind of earlier retirement years looking to build up charitable funds. And that's one reason why, somebody might use something like a donor advised fund if they're still income earning, if they're doing things like, selling real estate, their home and downsizing, or rental properties or something like that. And it's causing higher taxable income. We kind of call those like windfall events, where you could have higher taxable income because of a transaction or in your early years. And they'd love the idea that they can get the tax benefit now and then have that fund available for charitable activities in those later years. And so we often see people incorporating what they're doing for personal financial planning, estate planning, and also their sort of charitable fund planning at the same way. And that's why we are finding ourselves actively using this special restricted fund idea, because people that are making regular gifts to things like their church, the local homeless shelter, the cancer society, the things that they really care about that are ongoing, can go into a restricted fund for the benefit of those kinds of organizations. And once that's established, because we're a public charity, a QCD can go there for those particular purposes. And a fund like that will work with families so that that field of interest is defined very specifically for the things that they care about. And now there's a fun tool in place to do that. So like I say, it's not a donor advised fund, and Ransom, made some good comments about thinking about, when you would want to use something like that and when you wouldn't. One of the things that we find with our families is that they like the idea of eventually having charitable funds that will outlast them. Some folks like the idea that they'd like to maybe have an endowment or a fund that lasts 20 or 30 years after they're gone, and didn't realize that they could do something like that. Many individual charities will have things like endowment funds, scholarship funds. So if you really care about your alma mater or your local school or something like that, they may have endowment funds that you could, add to. You might want to create a memorial fund that not only you can invest in, but others can add to as part of their memorial gifts. And so those are reasons why people sometimes are interested in establishing a fund that can then be used to support multiple charities at the same time. It makes it more convenient also, because you're dealing with one or two distributions a year that go into charity for your tax planning, and the charity itself then is managing the individual distributions going out. Those funds can be invested tax-free. We often work with financial advisors on larger funds like that, where your financial advisor can actually retain the investment advisory on that. So we love working with teams in that way. And just keep in mind, as we're saying, these QCD gifts, that magic age 75, are not included in your taxable income. If you can keep it off the top, that's really strong financial planning. Okay, let's move on. Again, with a restricted fund, which at our place we call the Harvest Fund, you are the designated donor. That happens by signing an agreement that details what that restricted fund will do, the purposes that can be funded with it, and that becomes a contractual agreement between the charity and yourself. And so the Harvest Fund can have your family name on it. It can accept these. We again designed it specifically with the kind of IRS language that needs to be in there, so it can accept the QCD gift. Distributions to charity can include an acknowledgement to you if you'd like the charity to know that you're the sponsor of this fund, or they can be anonymous. Sometimes donors like to make gifts and not necessarily know that, have people know that where that gift came from. The agreement can be amended by, mutual agreement between you and the charity at any time. And again, you can plan for a fund like that to continue after your death as a legacy or a memorial fund, which is always interesting for folks. Okay, we go to the next one. Because these kinds of restricted funds are completed gifts to charity, charities don't pay income tax, they don't pay capital gains tax. Usually there's a very narrow kind of a tax on what's called unrelated business income, but most charities don't participate in those kinds of investments. So once you have funds at a charity that are going to be useful over a period of time, there is that potential to be able to invest them tax-free. So just like in your saving years for your IRA account, all of that income and gain builds up tax-free. The same thing can happen in a restricted fund at a public charity. The investments can build up tax-free. The cool thing is when the distribution's made, it's also tax-free because it's charity. And so a charity to charity distribution is never taxed. So you really get a strong benefit by planning for almost like a charitable savings account along with your other financing accounts that can be used. And we find oftentimes, people worry a little bit more in their later years. Am I going to need nursing care? Am I going to need assisted living? Maybe you want to help the kids or grandkids with college costs or, down payment for a home later on. If in the early planning years, you're planning for a charitable giving fund. And again, this combination of using the QCD with this more limited restricted fund is another great avenue. Now you've got those funds in place. It's just like we take care of, we maybe buy an insurance policy that pays for assisted living in later years. This is the same thing you can do, is to pre-fund your charitable giving for the rest of your life, which is fantastic. Interest, dividends, and gains add to funds like this. Again, it's the investing is, we always recommend best for funds that you don't want to have distributed for a year or more. We're all watching what this investment market's doing right now. It's bouncing around. It's been mostly bouncing toward down, which is not as cool as bouncing towards up. But, just like with anything else, if you're spending budget for the next year, it's probably safest to keep it in money market or savings or something that's got a very safe return or a cash account. We recommend the same thing with charitable funds so that you're not losing money unnecessarily. And so the idea is that you can build charitable funds over time. Maybe I'll before we go to the next slide, just see if there's if Ransom wants to comment anything about this idea of using retirement savings to generate a charitable savings, or because I do want to touch on the stretch idea in a minute, but it's a different subject.
Yeah, no, I think the stretch idea is good too, and I've got some great information around that as well. I will say one thing that a lot of people probably don't realize, that when you're on Medicare and taking Social Security, Part A is right, quote unquote free, right? We've paid for it our entire lives. So there's no immediate charge for it. You do, however, have to pay for Part B, and Part B is income based. And so anything over $182,000 it essentially increases your Part B premium by about 7 to 8%, right? And not a whole lot, right? It's maybe $300 or $400 more per year. But let's say you're retired and you have some deferred compensation come in from an employer. You sell an asset, whatever the case may be. Now all of a sudden you find yourself in a $300,000 bracket for Part B, and now instead of paying around $2,000 a year, you're paying $4,000 to $6,000 a year for Part B. So doing these charitable deductions and getting this stuff out helps reduce your overall income for those purposes. So not only is there immediate benefit to the charity, there's also benefit to you from a tax perspective. And don't get me wrong, right? I don't mind paying my fair share, but I don't want to pay any more than I have to. And I don't want something like deferred compensation or me selling a rental property or a little business that I have or a storefront to shoot myself in the foot. And now all of a sudden what I thought was a really good windfall now turns out to be detrimental to my long-term success. So there's tons of different avenues to look at and tons of different things to plan. Again, that's why I just encourage you to build a team around you that understands your goals and objectives and get them to navigate these complexities for you and help you understand these different situations.
We
Great.
did have a question right now. We're getting some great information. I will tell the attendees, we will be sending out a replay of this event to your email, and we will be posting it on our website, because I know this is maybe more than anyone can digest in maybe one sitting. You might want to watch it again. So let's go ahead and move on to this next part you said about stretch IRAs.
Good. Okay, I'm going to switch gears just a little bit and introduce this idea. So Ransom mentioned to you that the tax rules changed a few years ago, where taking your required minimum distribution moved from age 70 and a half to age 72. And again, as a reminder, they left alone the QCD to charity, which we were so grateful for. But when they moved up that age to age 72 to have to take RMDs, the IRS also took away the ability for when we leave behind IRA assets for kids or grandkids to inherit. They took away half of the length of time. So they used to be able to elect a stretch that could be up to 20 years, and they shortened that to 10 years. And so there's a couple things we always like to suggest when we're helping families think about charitable planning. We're often sitting side by side with folks like Ransom or an estate planning attorney or something like that, thinking about the whole big picture, how these pieces fit together. And inheritance of anything can be a blessing, or it can be, it can create challenges for your kids or grandkids. There's a lot of data out there that demonstrates that if too much inheritance goes too soon to the next generation, they tend to spend it all out in 3 to 5 years. And so oftentimes us as parents or grandparents, we want to leave an inheritance, but we also want to leave an incentive. And one of the ways to do that is to say, we want to leave you inheritance, but we want that to be distributed to you over a period of time, so you can't spend it too soon, so you can learn how to manage, so you can save that for a down payment, those kinds of things. Well, when we could, stretch that out over 20 years, a large inheritance over 20 years, that's nice kind of income stability for our kids or grandkids. Shortening that, particularly with larger estates, concentrates that, throws our kids into a higher tax bracket, may, really incentivize them to spend it out rather than investing it. And so, the creative estate folks out there looked at that change in rule and said, what can we do with that? And thank goodness that the IRS did not take away this idea I'm going to share with you now. And so the idea that we can still do is to add inheritance in our living trust and in our documentation for inheritance. We can direct that the amount of inheritance that we want, say, our kids to have, instead of going to them directly or going to them up to a 10-year election period, we can specify that it must go into a specific kind of a trust that's called a charitable remainder trust. It's usually called a charitable remainder unit trust, CRUT for short. And the nice thing about that is that the charitable remainder unit trust can have a longer life. And so we can now re-stretch that up to 20 years again by saying, please put that into a charitable remainder unit trust. When that happens, these charitable trust types are charitable entities. They're irrevocable trusts. And that then from estate rules goes over as a charitable distribution that permits the trust to make income payments to family members for up to 20 years. So you can see with this idea how combining these ideas, and this is where having a team can help you figure out what you want to do and how you want to do it, is so beneficial to you that now you can re-stretch that inheritance for up to 20 years to family. If you're charitably minded and you want charity to receive something, but you want your kids to benefit also, this is a nice way to do it, because the way these trusts are structured, when the trust is finally finished, that 20 years down the road, whatever's left over in that trust goes to charity. And you can name who those charities are. You can even name your endowment fund, your a testamentary donor advised fund, your testamentary harvest fund, any of those kinds of things. You can name multiple charities. So it's an important idea to keep in mind for particularly larger inheritance, and ways to incentivize for your family to keep it non-taxable for longer. And again, once it's inside that charitable trust, those assets can be invested inside the trust tax-free. The only portion that's ever taxed as it comes out to your kids, and some of it could even come out as capital gains instead of ordinary income over time. So it's a powerful idea. You don't read about this stuff on, Good Morning America or anything like that, but it's good for you to know it and to ask your advisors, hey, I heard I can stretch the IRA inheritance using a charitable trust. How does that work?
Yeah, I can tell you right now that the Charitable Remainder Trust is one of the most powerful tools that we can use for philanthropic-minded people. One question I often get is that, so my beneficiaries only receive income and that's it. Well, that's one way they can receive. You can also put provisions in that upon obtaining a certain age, they may withdraw a certain percentage, and or there's what's called ascertainable standards inside of a trust, which is essentially health, education, maintenance, and support. Those can be written as tightly or as loosely as you want, being the grantor of the trust. And the point being there, right, if my son wrecks his pickup truck, right, we're in Texas, so I'm going to say pickup truck, wrecks his pickup, the trust can buy him another truck, but it can't buy him a Lamborghini, right? That's not normal maintenance and support. So as long as it's those types of reasonable, ascertainable standards, you're fine. And a lot of us, right, we don't want to leave our family holding the bill for some medical needs or whatever case may be there. So the trust can step out of those bounds and pay for some of those things from time to time. But again, those do have tax consequences, not only in the short term, but in the long term. But it's not 100% all the way to that charity. So there is some flexibility in there. Again, just important to work with an attorney and make sure that what you want done is actually done, and you have the documents to support that and make that actually happen.
All right.
Great.
Ransom, if you can go ahead and finish us up here, and then we'll go ahead and take some questions.
So I think I've talked about this quite a bit, right? An advisor can help you do all kinds of things, and don't forget too that investments and charitable giving, yes, are part of the equation, but they're about 40% of the equation. There's still multiple things out there that need to be tied up and taken care of. I always refer to it as tidying up the financial house, right? If your kitchen's clean and your living room's clean and the rest of your house is a disaster, you really don't have a clean house. So tidying up the entire financial house is extremely important, and just an efficient way to do things. 20 years ago, if we were headed from Texas to California, right, and we were on our way to go see Kathy, we would just kind of point the car in a westerly direction and mosey on down to California. That's one way to get there, right? But now we have efficient maps and nice ways to make that trip as streamlined as possible. We even have ways to find out where the cheapest gas is and maybe the most affordable attractions in between here and there. So that's what a financial plan is, right? It's just a way to get from A to B, accomplish everything in between, and do it the most efficient way possible. And are we going to have curveballs thrown at us and things to derail us from time to time? Absolutely. That's why you have to have an ongoing relationship with a financial advisor, just to make sure that when life does throw us a curveball, we adapt and overcome that situation and then continue to plan long term. We always say the two things in life that are for sure, right, are death and taxes. Well, I always say the three things that are in life for sure: death, taxes, and change. So if you're not changing as your life changes and you're not changing your financial plan, the two are kind of, competing with one another. The old days of, me printing out a 100-page document and giving it to you and saying, here's your financial plan, those days are over. The financial plans we do today are interactive. You log into them, you can build what if scenarios, we can see what's going on, we can tweak things. What if this happens and what if that happens? And we can really become comfortable with our situation. And, and to Kathy's point, well, what if we give 80,000 this year as a QCD? What does that do to our tax situation? How does that impact our Medicare? How does that impact Part B? There's all kinds of moving parts and pieces, like I've mentioned before, but again, it's a fantastic feeling to have a good, well-built team surrounding you, helping you with these complexities and helping you make these decisions.
All right, we're going to go ahead and open things up for questions. I will tell our attendees, go ahead and put your questions in the chat. If we're not able to get to it, go ahead and leave your contact information. We'll be able to take several questions, but we won't be able to do all of them probably. So let's go ahead and get started. Here's a question about if you give to a restricted charitable fund like the Harvest Fund, can you give it to more than one charity?
Yes, and the short answer to that question is yes. The reason that I'm talking about a restricted fund and not a donor advised fund is that the distinction is that you think about the kinds of charities that you're already supporting, what you'd like to do, currently with distributions to multiple charities. Most of the folks we work with, know the 3 to 5 or 6 charities. Gosh, we've got some donors that have over a dozen charities that they support on an annual basis. And so when we know what that is and you're budgeting for what you'd like to have as charitable giving, the nice thing about using a restricted fund like this is that that's all predefined in the restricted fund, with us knowing who those charities are. And so, yes, you can distribute to multiple charities. It's also possible, like I say, to amend the agreement over time, but we have to be, we're just careful that it doesn't start to look like a donor advised fund. But then you've got this ability of building up fund balance and investing and having the distributions to the charities you care about come from income and gains, and have that fund last for a very long time. So there's a lot of benefit to it. And, so many of our donors, they care about these charities for the long term. When we think inheritance, we're thinking about how do we equip the next generation. We also want to think that way with the charities that are the most important to us. How can we help equip them for the next generation? And so thinking about a way that we can provide support over a longer period of time can be a wonderful, wonderful gift that we leave behind as part of our legacy.
Yeah, I agree. There was another question that came in that says, do I need to itemize my tax return if I'm donating to a restricted charitable fund like the Harvest Fund? The answer is depends, right? And that's a financial planner's typical answer. If we're donating non-qualified, so non-IRA, non-401k type assets, let's say, for example, maybe a highly appreciated piece of real estate. It may make sense to save your charitable donations for a couple of years and kind of stack them or bundle them, if you will, because today's standard deduction is so high that very, very few people actually need to itemize. And so by maybe stacking some of your donations, not doing it one year and then doubling up the next year, can be more advantageous than taking the standard deduction. And don't forget too that if you exceed 60% of adjusted gross income, which is the maximum deduction for non-retirement type assets, that does carry forward for up to 5 years. So you don't lose it. You'll have some remaining benefit from that for a few years to come. But again, you don't have to itemize to make the charitable donation. But it may be advantageous to stack or bundle your itemized donations every other year instead of doing it every year. Again, just because that standard deduction is so high these days, especially for married filing jointly. It's really high. I don't suspect it'll be that way very much longer, but it is at least until 2026. So consider those things. Another question we got is that can I give to a global nonprofit, or does it need to be local or in the U.S.? I'll short answer this, and then I'll let Kathy expand on it. Most charities that have global outreach are based in the U.S. so that you can give to them and benefit from a tax perspective. They still may have arms and do different things outside the confines of the United States. Kathy, what about on y'all's side? Do things stay globally or more?
So well, in general, we say the same thing. The thing to ask is that entity operating under a U.S. tax determination letter? So there are lots of charities that do work internationally that have established a U.S. Tax determination as a charitable organization. And so you ask that question. We do occasionally get a request to support an organization that's actually organized and operates as a foreign charity. And you'll find that most foundations will have an option to research that. If it's something that they can easily determine that this is a charity, they may tell you they can do that. It takes more work on the part of the charity to do that. A lot of charities just say, we can't do it. We'll take a look for with our donors if it's something that we can easily determine. But again, there's so many. If you're wanting to support charitable work in Africa, for instance, or in Southeast Asia, there's so many U.S. based charities, and then there's no question about the fact that you can get a charitable deduction. You can obviously send money anywhere you want to. The difference is whether it's eligible for a tax deduction or not. In order to get a tax deduction, if you itemize, it's got to meet U.S. charity rules. So, but we usually work with people and either try to find an entity that's got a U.S. base for them, or, if it's something that's a well-established international charity, we'll sometimes approve that. I see a question here wanting to clarify these two ages we talked about, Ransom. Clarify the QCD age. So we talked about age 72 and age 70 and a half. So think of this, 70 and a half is the magic age to start taking charitable distributions if they go direct to a charity. So charity first. And then at age 72, the IRS makes you start taking RMDs. And that's when, people go, well, if I've got to take the RMD anyway, and I'm a charitable giver, why don't I direct a part of it through a QCD? So the 70 and a half is the magic age that you can start doing a QCD. That's the charity early. 72 and a half is when you have to do it regardless.
Yeah, and something too, we mentioned earlier, that needs to come directly from, a QCD needs to come directly from your custodian. And that would be, whoever houses your investments. And we use a third-party custodian, here at U.S. Capitol. But what we do is essentially the first half of a piece of paper, a regular sized piece of paper, is a letter to the charity stating who you are as the client, expressing why you would like to support that charity if that's something you want to say. And then just a little bit about, this is coming to you as a qualified charitable donation. And then the bottom third of the piece of paper is a detachable check made out to the organization. So the check doesn't just show up and the charity thinks, oh, this is great. Look, I got a check from Bill. Well, it actually shows, hey, this is Bill. I want to support this organization and this is why, and is a nice letter and provides that. And so that's a nice way to do that too. And that way all the boxes are checked for the IRS. There's a paper trail. There's, evidence, so to speak, that you actually made that to a charity. Another question too is that we often hear the term 501c3, right? And I know that's a little nerdy for most people, but that's the internal revenue code for a nonprofit. And there is a difference between a private 501c3 that Kathy mentioned earlier that could be like a family foundation, or a foundation that someone has as a private foundation. So make sure that if you're looking that it's a 501c3, but it's a public 501c3. And I know Kathy mentioned that would be hospitals, churches, universities, things of that nature. So just make sure that that's appropriate. And you can easily find that out just by Googling them, looking them up on the website. And any charity that is a public 501c3 will make that blatantly obvious, because they would like to get charitable donations.
All right, I think we have time. Oh, go ahead.
Sorry, are we done?
No, we can take about one or two more questions. So go ahead, Kathy, what you were
I
gonna
saw a
say.
question about, do I need to itemize? And this can be sometimes confusing. With the QCD gift, because that's a direct gift from your IRA to charity, you don't have to include that in your adjusted gross income. And so there's no itemizing to do. And this is a really powerful thing, because as Ransom said, a lot of people don't, once they are retired on fixed income, they're not itemizing anyway. Their houses are paid off and they just don't have enough, other kinds of deductions to be able to itemize. So that's where QCD can really be a powerful help to you. Just know that the reporting on it is another good reason to have an advisor or a tax preparer come alongside you so that you do it right. When you get the 1099 form from your IRA account at the end of the year, it will include the amount of QCD. And it's up to you when you do your tax return to include that in a little memo line to the left of where you add those things up, but subtract it when you put it on your tax return. And you should also be getting a tax acknowledgement letter from the charity. And we do this every year. We say, thank you very much for directing the QCD gift. And so that paperwork, along with the 1099, is what you use to keep from adding it to your gross income right off the top. So it's a little different reporting technique. You don't have to remember what I just told you. Just remember, if you do a QCD, there's a different reporting technique, and ask your advisor when you get to that point how to handle it.
Yep, good point.
All right, we have time for about one more question, Ransom.
Yeah, so I do see here too that, so this is, yeah, so okay, so I think I understand the premise of this question about benefits for donating non-retirement assets. So I guess this is something I mentioned earlier, right? By donating highly appreciated assets, if I paid $100 for something and it's now worth $1 million, right? If I sell it, I've got to pay taxes on that difference. It is capital gain tax, but if I donate that, then no, I don't have to. I could also donate that to a charitable remainder trust, like Kathy mentioned earlier, and I can receive income from that. But then when I pass, or a certain period has passed, then that property, that asset goes to the charity and they're in control of it. So yes, there's tons of benefits to gifting qualified money, IRAs and the QCDs. There's also benefits to gifting taxable money, right? It reduces your income tax for the year. It can reduce your estate, and anytime so there's federal estate tax, and then many states, I think only 4 states don't have state estate tax, and so to reduce that is advantageous. Now, currently the federal exemption is a little over 11.5 million per person. That's not going to stay that way forever, right? It's going to come down at some point. So you can reduce your estate by gifting some of these things and getting them out of your estate. So highly appreciated property is one thing. Income producing property is another. Things that appreciate is another way to do it. Again, so there's multiple benefits, not just to the charity, but to the person making the gifts. The charitable gifts that can be explored and obtained and looked at from a tax perspective and a state tax perspective. And then, do you need the income now? Do you need it later? Which would lead to the charitable remainder trust, or maybe a charitable lead trust, which is the opposite of a charitable remainder trust. That still is very advantageous. It just depends on your situation and what fits you and your family and your goals and your objectives the very best. I think I answered that last question okay. And if we didn't, put your contact information in. We'll definitely get back to you and get that answered in more detail. And a lot of times there's specifics in your situation that aren't really covered in this kind of general conceptual discussion that we'll be happy to talk to you about later.
Well said. I think I would just add, if you're charitably minded and you are, the beneficiary of highly appreciated assets, real estate or whatever, just know that there's a way to reduce or sometimes eliminate that capital gains tax by incorporating your charitable goals along with your estate and income goals. We do an awful lot of that. We're doing an awful lot of real estate transactions these days because people are downsizing, don't want to have to pay capital gains tax. And once they realize, you don't want to procrastinate and end up with a rental property longer than you care to manage it, or, end up in your personal residence longer than you want to manage it. It's just, you don't have to do it. There's so many great tools out there to help you accomplish all of your goals and to reduce taxes at the same time. I say, thank you often. That the charitable deduction and some of these charitable benefits, Congress has pretty much left them alone all these years. And so we're very grateful that they are still supporting charitable giving, and you ought to know it and know that there's ways to really take advantage of that and leverage the assets that you've been able to accumulate.
Well,
yeah, absolutely.
Thank you so much, Kathy and Ransom. What an informative webinar today. I'm sure that, as I said before, you will, our attendees might want to look at the replay to review this information. It's been really, really information rich. On behalf of Advice Chaser, I want to thank the organizations that have worked with us to bring you this webinar today. And to our attendees, just a little more about us at Advice Chaser. We're all about helping you find a financial advisor who's a great fit for your life and your financial questions. Our matching service is free to you, and every one of our advisor partners has committed to offer a free initial consultation to anyone we introduce them to. Find out more by going to advicechaser.com and clicking on the link to find an advisor. Once again, from Advice Chaser, thank you so much for coming, and we'll see you at another webinar soon. Goodbye, everyone.